Have you ever wondered about the first digital currency that started the crypto revolution? In the digital dawn of 2009, a mysterious figure known only as Satoshi Nakamoto breathed life into an idea that would reshape our understanding of money. This idea was Bitcoin, the world's first cryptocurrency. Satoshi's groundbreaking white paper, Bitcoin, a peer-to-peer electronic cash system, laid the foundation for a decentralized form of currency, one that did not rely on banks or governments, but on the power of cryptography and collective trust. Bitcoin's birth was not heralded with fanfare. It was a quiet revolution, born out of the ashes of the financial crisis of 2008. Satoshi Nakamoto's vision was to create a financial system that was immune to manipulation, a system where trust was not an issue. And so, Bitcoin was born, a coin that existed only in the digital realm, its value derived not from gold or governments, but from mathematics and consensus. Yet, in its early days, Bitcoin was met with skepticism. Mainstream finance disregarded it as a fad, a niche internet money for tech enthusiasts and cyberpunks. After all, who would trust a currency without a central authority, without physical form, without a long history of acceptance? But Bitcoin was not deterred. It continued to exist, to be mined, to be traded. It was a silent undercurrent, growing stronger with each passing day. Those who understood its potential knew that it was not just a currency. It was a new way of thinking about money, about trust, about decentralization. In the beginning, one Bitcoin wasn't worth much. The first real-world transaction with Bitcoin took place in May 2010, when a programmer named Laszlo Hanyecz bought 2 pizzas for 10,000 Bitcoins. Today, those pizzas would be worth millions. Little did the world know, this was just the beginning of a financial revolution. What caused these digital coins to rise from obscurity to the limelight, you may ask? Well, it's a story as intriguing as the concept of cryptocurrencies themselves. In the early days, cryptocurrencies were largely dismissed as a niche interest, a fringe element of the financial world. But as the years rolled on, the public's curiosity was piqued. The concept of a decentralized digital currency, free from the constraints of traditional banking systems, was, to many, an appealing prospect. This burgeoning interest was fueled further by the media, who latched onto the narrative of cryptocurrencies as a disruptive force in finance. But it wasn't just public interest and media coverage that propelled the rise of cryptocurrencies. The advent of blockchain technology played a pivotal role too. This revolutionary technology, with its promise of secure, decentralized data management, was the perfect vessel for cryptocurrencies. Blockchain offered a level of security and transparency that was previously unheard of in financial transactions. As cryptocurrencies gained traction, Bitcoin was no longer the only player in the game. Other major cryptocurrencies began to emerge, each with their own unique selling points. Ethereum, for instance, introduced smart contracts, automated agreements that execute when their conditions are met. Ripple, on the other hand, focused on optimizing international transactions, aiming to make them quicker and cheaper. Then there was Litecoin, a cryptocurrency that promised faster transaction confirmation times and a different hashing algorithm. These new entrants to the cryptocurrency market added fuel to the fire, driving the value and popularity of digital currencies to new heights. It was a time of unprecedented growth and excitement in the world of cryptocurrencies. Yet, this period of explosive growth was not to last forever. As the saying goes, what goes up must come down. The crypto market was booming, but as with every boom, a bust was looming. How did these digital assets, once hailed as the future of finance, face such a dramatic downfall? It's a question that's been on the lips of many as they've watched the value of cryptocurrencies tumble in recent years. Let's take a step back to understand how we got here. The allure of cryptocurrencies is their decentralized nature, free from the control of central banks and governments. But this very feature has been the root cause of many of their problems. Regulatory bodies across the globe have grown increasingly wary of these digital currencies, sparking a series of crackdowns that have sent shockwaves through the market. For instance, South Korea's plan to impose a 20% tax on crypto transactions rattled investors, contributing to a market-wide plunge. Security concerns have also played a significant role in the downturn. Despite the sophisticated encryption techniques used in cryptocurrencies, hackers have found ways around these defenses, leading to several high-profile thefts. These breaches have not only resulted in substantial financial losses, but have also shaken confidence in the security of these digital assets. But perhaps the most significant factor in the fall of cryptocurrencies is market volatility. Wild price swings have become a hallmark of the crypto market, fueled by speculative trading and sudden shifts in investor sentiment. This volatility was on full display during the Bitcoin crash of 2018, where the value of Bitcoin plummeted by over 70% in less than a year. More recently, the crypto volatility index has been on the rise, with Bitcoin experiencing a monthly loss of around 38%. It's also worth noting that influential figures and companies can have a tremendous impact on the market. When Tesla announced it would no longer accept Bitcoin payments due to environmental concerns, the news triggered a significant drop in Bitcoin's value. These factors combined have led to the sharp decline in crypto values we've seen in recent times. The crypto market was in turmoil, but was it the end of cryptocurrencies? Not quite. The story continues, and as we'll see in the next scene, it's far from over. Is there a future for cryptocurrencies after the roller coaster they've been through? In the face of volatility, cryptocurrencies are showing resilience and a capacity for stabilization. Despite the fluctuations, a pattern emerges: a rise, a fall, then a period of stabilization. This cycle reflects the growing pains of a new technology as it finds its place in the world of finance. Mainstream financial institutions are recognizing the potential of these digital assets. They're moving from dismissing cryptocurrencies to cautiously exploring their use. Major banks are now offering crypto services to their clients, and businesses are starting to accept digital currencies as payment. This adoption by mainstream finance has played a significant role in the current stabilization of cryptocurrencies. A key player in this evolution is the rise of central bank digital currencies, or CBDCs. Central banks across the globe are developing their own digital currencies, a clear sign of the shift in attitude towards the crypto world. CBDCs combine the convenience and security of digital currencies with the regulated and recognized environment of traditional finance. But what does the future hold for cryptocurrencies? Well, their potential extends far beyond being a mere medium of exchange. They're at the heart of a technological revolution, leading the charge in decentralization and data security. Blockchain technology, the backbone of cryptocurrencies, is changing the way we handle data, making transactions more secure and transparent. Cryptocurrencies are also breaking down financial barriers, offering services to those who are unbanked or underbanked. They're democratizing finance, giving people control over their own money, and opening up a world of opportunities for financial innovation. So, despite the roller coaster ride, the future of cryptocurrencies looks promising. They've proven their resilience, survived the skeptics, and are now part of our financial landscape. The volatility might make headlines, but it's the potential of cryptocurrencies that will write the future. Cryptocurrencies have weathered the storm and are now shaping up to transform the world of finance. Let's take a moment to reflect on the journey of cryptocurrencies. We've traversed through the inception of this digital currency, starting from the birth of Bitcoin, the pioneer that paved the way for a new financial frontier. We've seen how it sparked interest and how it led to the rise of numerous other cryptocurrencies, birthing an entire ecosystem of digital assets. We then shifted our focus to the dramatic ascents and descents of these digital currencies. We explored the factors that prompted these drastic fluctuations, like regulatory concerns, market volatility, and key decisions made by influential entities. We witnessed Bitcoin's plunge of over 8%, trading below $36,000, and the ripple effect it had on other major cryptocurrencies like Ethereum, Binance Coin, Cardano, and Dogecoin. But this journey isn't marked only by rises and falls. We also discussed the stabilization of cryptocurrencies. Despite the roller coaster of changes, experts still believe in the rebound of Bitcoin and other digital currencies. They cite factors such as the rise of central bank digital currencies and the upcoming Robinhood IPO. But the story doesn't end with cryptocurrencies. We also delved into the technology behind these digital assets, the blockchain. We explored how this revolutionary technology is not just underpinning cryptocurrencies, but also transforming financial transactions and data security. So, where does this leave us? It leaves us at a juncture where we're witnessing the unfolding of a digital revolution. A revolution that's not just changing how we transact, but also how we perceive value, security, and trust. The story of cryptocurrencies is still being written, and only time will tell where this digital revolution will lead us.